What's going on? I hope you're doing great. This is one of my favorite times of year as an investor because Warren Buffett releases his annual letter to the shareholders of Berkshire Hathaway. And we are huge proponents here of modeling success and understanding how the greatest minds and investors and entrepreneurs manage and set principles to run their overall financial lives. And so I thought I would take this opportunity to give you the Cliff Notes version and really review with you Warren Buffett's letter to shareholders so that you can begin to incorporate some of the principles that he talks about. We'll break them down into plain English, not just from a business standpoint, but how you can impart them perhaps and what it might mean for you as an individual investor. So let's go through this together. One of the first things that Buffett explains is that the company, their prime goal in the deployment of your capital is to buy ably managed businesses in whole or in part that possess favorable, durable economic characteristics. And we also need to make these purchases at sensible prices. So what Buffett's saying here is he's a steward of the investor's capital. And their goal is to be able to buy good businesses that have competitive advantages, that have the ability to last for many, many years based on consumer and business behavior, these economic advantages, and that they also need to make these purchases at sensible prices. He wants to buy good companies at fair prices. He's not looking to buy the cheapest priced investment out there because cheap doesn't necessarily mean it has the quality that he is looking for. So he wants sensible prices. He then goes on to say, the sensible course for them has been clear. Many stocks have offered far more for our money than we could obtain by purchasing businesses in their entirety. So they're finding some opportunities to purchase stocks in the public market. They haven't been able to find those things in the private market. So they're finding some value in the public market. Now, I want to talk to you next about what they talk about is stock buybacks. He says Charlie, his business partner, and I think that if as an investee's stock is underpriced, we rejoice when management employs some of their earnings to increase Berkshire's ownership percentage. So companies sometimes buy back their own stock. Think about this for you. If you own a business and then you sell some of your business to outside investors, if you're able to buy that stock back from investors at a low price, it's going to give you the ability to increase your return on your equity. And so they look for companies that do this, and they also they do that themselves at Berkshire. They will buy their stock back when they believe it gets to a low price. That increases their ownership percentage. It increases the dividends and the cash flow that they receive from those companies. So they like smart managed owners buying back stock when the stock is reasonably priced. Another really important thing that Buffett points out is Berkshire held $112 billion at year-end in U.S. Treasury bills and other cash equivalents, and another $20 billion in miscellaneous fixed income instruments. We consider a portion of that stash to be untouchable, having pledged to always hold at least $20 billion in cash or equivalents to guard against external calamities. We have also promised to avoid any activities that threaten our maintaining that buffer. So what does this mean for you? Do you have an emergency fund or an uncertainty fund or a specific amount of liquidity that you will never jeopardize? Buffett has that. He's making sure that it is always in place, and he is willing to forego higher returns on that $20+ billion to make sure that he can avoid financial calamity. You need to have the same thing in place for your financial life, an adequate emergency reserve and principles that will make sure that you have the ability to survive any difficult period that may show up in your financial life. We don't know when it will happen. It might never happen, but the key is to have something to ensure that your company and your financial life remains a financial fortress. Berkshire will forever remain a financial fortress. In managing, I will make expensive mistakes of commission and will also miss many opportunities, some of which should have been obvious to me. And at times, our stock will tumble as investors flee from equities, but I will never risk getting caught short of cash. He's going to make mistakes. We all are as investors. He's going to miss some opportunities as an investor. Perfectly fine. But he's never going to make the biggest mistake, and that's getting caught short of cash, not having enough liquidity. Yes, he wants to move some of that excess liquidity into businesses that Berkshire will permanently own. So he will invest some of that money, but he's not going to ever jeopardize that cash buffer. However, he's also saying that the immediate prospects for that are not good, as prices are very high for businesses possessing decent long-term prospects. So sky-high prices aren't sensible prices. Then he goes on to talk about, my expectation of more stock market purchases is not a market call. Charlie and I have no idea as to how stocks will behave next week or next year. Predictions of that sort have never been a part of our activities. Our thinking, rather, is focused on calculating whether a portion of an attractive business is worth more than its market price. The greatest stock market investor of all time, arguably, does not predict the future. He looks for companies that have a great business that he can buy at fair prices. He's not trying to figure out what's going to happen in the next year, the next week. That is unimportant to him. So you don't need to be in the prediction business to be a successful investor and wealth builder. Very, very important stuff for you to understand. Another thing that he does is, in the publicly traded stock market, like Berkshire Hathaway is, every company has to report earnings on a quarterly basis. Charlie and him have never focused on current quarter results. They are long-term oriented investors. They are making decisions that in the short term that do impact the long term, but one quarter does not tell them or paint the full picture. And they're not going to focus on one quarter's results. They are going to take a step back and understand the broader trajectory of a company and not get scared because of one quarter's earnings that slowed down. They're going to look at things more sensibly, more rationally from a longer term basis. This would serve you as well to make sure that your decision making is based on the long-term nature of your company, and then make sure that your short-term decisions are focused on those long-term goals and objectives. He goes on to talk a little bit more about Berkshire's unrivaled financial strength, which allows his company to have far more flexibility in investing their excess cash than generally available private property and casualty insurance companies. The many alternatives available to us are always an advantage and occasionally offer major opportunities. When other insurers are constrained, our choices expand. So you can see that by managing their finances fiscally responsible, when everyone else gets in trouble, they are there ready to capitalize and take advantage of those opportunities. They're not investing now just because they have excess cash. They're waiting for the right opportunities that meet their criteria before they invest. And if other people don't manage their finances appropriately, it's going to give them an opportunity to grow and expand their businesses when everyone else is facing tough economic challenges. So think about how you can make sure that that is the same case for you and your business during the next economic challenge. He also goes on to say that rational people don't risk what they have and need for what they don't have and don't need. We see many people who have more than enough and have been accustomed to investing for growth their entire life. That the same level of risk taking is not critical now as it once was, because they've quote unquote won the game. They have more than they ever will need. So you need to be of that same mindset, that why risk what you have and do not need for something that you don't need? So really, really important principle. And it's a big mindset shift when you've been investing and taking risk your entire life and focusing on growth, to now step that back and preserve what you have. Don't risk what you have and need for what you don't have and do not need. If you've won the game, you can stop playing. Then they go on to talk about the $173 billion that they have in stocks. And you can see all the companies, American Express, Apple, Bank of America, and so on and so forth. They do not view the $173 billion as ticker symbols, a financial dalliance to be terminated because of downgrades by the street, expected Federal Reserve actions of raising or lowering interest rates, possible political developments, forecast by economists, or whatever else might be the subject of the du jour. They are not getting swayed out of their investment views because of analysts, because of what the Fed is doing today, because there's a Republican in the White House or a Democrat in the White House, because some economists thought GDP is going to be down by 10%. That's not what's important to them in making decisions on their investment portfolio. Then they go on to talk about the American tailwind, how it's been great to be an American investor. Buffett made his first investment purchase in 1942, and he goes on to detail that right here. He said, if my $114.75 had been invested in a no-fee S&P 500 index fund and all dividends had been reinvested, my stake would have grown to be worth pre-taxes $607,000 on January 31st, 2019. That is a gain of $5,288 for every $1. Now, if you had this in a Roth IRA or you invested $1 million at that time, that $1 million would have grown to about $5.3 billion. So think about that, the power of compounding, the power of not being scared out because of, the headline of the day, because of the interest rates, because of a war. They remain disciplined and invested in strong companies that America has produced. And now he goes on to talk about our country's almost unbelievable prosperity has been gained in a bipartisan manner. This isn't a Republican or Democrat thing. Since 1942, we have had 7 Republican presidents and 7 Democrats. In the years they served, the country contended at various times with a long period of viral inflation, a 21% prime interest rate, several controversial and very costly wars, the resignation of a president, a pervasive collapse in home values, a paralyzing financial panic, and a host of other problems. All engendered scary headlines. All are now history. Think about that. Think about what our country has gone through over the last 77 years. Think of the high interest rates, the crazy inflation, the wars, the trade wars, the low interest rates, the printing money by the Fed, the government budget deficit, financial panics, Black Monday. All of these have happened. Yet his $115 grew to $607,000, or $1 million would have grown to $5.3 billion just by being a patient, disciplined investor and not focused on the headlines. If you don't believe America is going to be at a better place in the future than it is today, then you shouldn't be investing any of your money now. Then he also goes on to say there are also many other opportunities around the world that have bright futures. Americans will be both more prosperous and safer if all nations thrive. At Berkshire, we hope to invest significant sums across borders. For you as investors, most people in America have a home bias. It means the majority of your money is invested in United States companies and indexes, though that does not necessarily portend to the best opportunities in the future. And so he sees opportunities outside of the U.S. That's going to be a good opportunity for all investors. And he'll be investing abroad. So I would challenge yourself to understand, are you taking advantage of the global landscape with your investments? Because those opportunities do exist. They might potentially provide higher returns in the future. And Warren Buffett is open to creating that for his portfolio as well. So those are the big things and the big nuggets from Warren Buffett's annual letter to shareholders. It's a 14-page document. I highly recommend you read it. You can see that his returns have pretty much doubled the returns of the stock market since 1965. And so he's a good guy to learn from. It's worthwhile to take your time, enjoy. Let me know what you've taken from his letters. And here's to continued successful investing and wealth building and learning from the success and mistakes of others. And if you ever need anything, don't hesitate to email me back, matt@illuminationwealth.com. I'd love to talk to you more about investment strategy and how you can apply some of these principles to your financial life. Take care.